Hi, Jasmine here from Redwood Financial, and this week's frequently asked question is, with everything going on in the markets at the moment, is now the right time to cash out my investments? Great question and very topical with everything going on between Russia and Ukraine and obviously the impact it's having on global markets. But the answer about whether or not you should cash out is a resounding absolutely not. The worst thing that you can do when we experience market movements and fluctuations is to panic and turn a theoretical loss on paper into a physical loss by cashing out of your investments. Really what this is about is understanding the difference between having time in the market and trying to time the market. Timing versus time in. And so what do I mean by that? Well, a lot of you know, and I talk about this with my clients all the time, that real investments, true investments into the marketplace should never be done on a short-term basis. We should always have a long-term goal that looks for an investment horizon of between 5 to 10 years plus. That doesn't mean you should tie your money up and you can't get your hands on it if you need it, but we should have a long-term goal and objective, not a short-term goal and objective. And having that long-term goal and that time to stay invested in the marketplace means that we can largely ignore short-term market movements and fluctuations and not panic. And that is the only way to make sure that your investments provide the return that you're after over that medium to long-term period. If, on the other hand, you try and time the markets, so you try and work out when's the right time to cash out, when's the right time to buy back in, unfortunately, you're going to end up doing yourself a disservice, and all the evidence has shown that it actually generates far greater losses and impacts market movements and returns negatively. And what do I mean by that? Well, the reality of the situation is we don't have a crystal ball. In times when markets are falling, we don't know how long they're going to fall for and how long it will take before they reach that bottom. So we never actually know when's the right time to cash out, and we never normally get a lot of warning before there's heavy market movements. We might be expecting some things, tensions might be ramping up between Russia and Ukraine as they were, but you still can't ever predict exactly when Russia was going to decide to actually launch the invasion into the Ukraine, and then when we'd start to feel that market reaction. And so trying to time the market and cash out before an event happens is very, very rare and unlikely to ever happen. Normally what happens is someone panics after the market has already started falling. And that means at that point when you're cashing out, the damage has already been done and your investments have already suffered losses because the market has already moved negatively. So we're never normally getting ahead of these things. We're always normally reacting to something that's happened in the marketplace and has scared us, which is why we're normally then turning a theoretical loss on paper into a physical loss. But let's say, for argument's sake, that you did have a crystal ball and you knew to come out the day before markets started to have a bit of a tumble due to the Russia invasion of Ukraine. Fine, you're now sat in cash. You're not experiencing the up and downs that the market's currently going through. But the next question then is, when is the time to move back into the marketplace? When has the stability been achieved? When are we going to stop seeing that volatility? When has it reached the bottom? And when is it on the way back up? And no one can, again, know these things because a lot of what happens in the market is sentiment driven and reacting to things which are changing on a daily basis. Which means that you can't then know exactly when the right time is to go back into the marketplace. And potentially, if the markets have come down to here and then they start tracking back upwards, by the time you realize it's the right time to go back in, and this isn't just a blip, it is recovering solidly and stability wise, you're ready to go back in, you've now missed out on all of that growth, all of that recovery. Which means that if you had taken the money out and turned that theoretical loss on paper into a physical loss, you've then lost the opportunity for that growth to have recovered that loss, and you're now going back in at a higher point. Just think about it from a purely psychological point of view. We know that what we're supposed to do when it comes to investing is we're supposed to buy low and sell high. But actually, by trying to time the markets like that and reacting when markets are moving negatively, you're doing the opposite. You're actually selling out when they're coming crashing down, and you're selling low, and then you're waiting for them to recover before you buy back in. So you're buying high. It's the worst thing that you can do for your investments. The best thing to do is to stay calm and ride out the storms. Those losses are theoretical losses on paper, and actually if we just hold through, then those losses will be recovered and the investments will go back up to their previous values and then back into growth territory once we come out the other side of it. And we will come out the other side of it. We always do. It might take a few weeks. It might take a few months. It might even take a year, depending on the market conditions and what's going on and what's causing that market stimulus. Depends on how long sometimes it will take to recover. But again, the data and the evidence shows that equities always over the medium to long term have been able to provide positive returns if we just hold steady and stay true to the course. Now, whilst that's what you should do, it's also about understanding what your fund managers are doing behind the scenes. Because cashing out your entire investment and putting it into cash is obviously a panicked reaction. Now, that doesn't mean that we should just sit still and hold through the same investment strategy during times of market fluctuation. Far from it. What your fund managers should be doing, if they're good fund managers, is they should be using opportunities of market volatility to find those investment opportunities. Strategically cash out of funds that have done particularly well and are in profit, and bank those gains into other areas that are expected to shoot up as a result of whatever that market stimulus is, in terms of, it could be the Russia-Ukraine crisis, or it could be the COVID pandemic that we only had in market volatility just a few years ago. Whenever there's disruption in the marketplace, there is always opportunity, and there is always, therefore, growth pockets and sectors that will unfortunately benefit from a negative market situation. Now, it's our fund manager's responsibility to be strategic in those decisions about where to cash out from and where to then reinvest that money from. And that's their job. And they're looking at things from a purely logical and analytical perspective. And they're making those trades on a strategic basis, not a panicked basis of simply just pulling the entire portfolio into cash and sitting there hoping for the best. That's the worst thing you can do. Trying to time the markets like that never works. So from your perspective as an investor, the right thing to do is to stay calm and see yourself through that storm. But it's also important to make sure that your fund managers aren't just sitting still, and that they are being strategic and looking for those opportunities that any disruption to the marketplace will bring. So whenever you've had times of market turbulence before and you've had your investments take a little bit of a wobble, the question is, what have your fund managers been doing to take advantage of those opportunities? You can yourself take advantage of those market depressions as well, because if you do have spare cash lying around in the bank, that's the perfect time to invest it when the markets are low. But it's making sure that your fund managers are also working hard for you during that time, more so than ever, because that's where a lot of those opportunities exist. If your fund managers aren't regularly speaking with you, updating you, and your financial advisors aren't telling you what to do in these times of market volatility, then that's maybe where you might want to think about looking at alternative fund managers and advisors. We've got lots more information on our website and lots of blog articles all about investment management and how to improve the returns on your investments. So by all means, please check out our website for more information. And if you have any questions at all and you're worried about your investments, then just give the office a call and we can have a complimentary chat with you just to talk about you and your specific circumstances. I hope that helps answer that question, and I look forward to answering more questions next week.